wires the money, but is that real, title difference? So in those conversations with the CEO, they know where the money is. They know what needs, they're apprised of the situation before it gets to there. And usually it's like, how do we figure this out? And then if we can't figure it out, we're going to have to do something drastic, right?
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we are going to be talking about all the fun stuff today. So we're going to be diving into a lot of different things: fintech, biotech, life sciences, ag tech, food tech. What the heck is this going on? There's a lot of verticals we're going to be talking about, how to navigate it, what that looks like. And that's the reason why I have this next guest on. So you will want to hold tight and listen to this episode. Probably share this with a lot of your friends and family. He has just been an incredible amount of background. Just to share with you a little bit: investment advisor, portfolio management options strategist, fractional startup CFO. At the beginning, he works portfolio manager at Shibu Capital, portfolio manager at Parplex Capital, Bank of America. He worked with them, Montgomery Securities, and he's securities licensed in Series 7, 63, 65. So very, very reputable individual. He works very closely with a lot of startups and a lot of high net worth, ultra high net worth individuals, deploying a lot of capital in the alternative investing space. Please welcome my next guest, the founder and co-founder of Aureate, the one and only managing partner, Austin Milliken. How you doing today, Austin?
I'm doing great, Christian. Thank you for the nice intro there.
Dude, I'm so excited and pumped up about having you on because, what's so interesting is we've had a lot of individuals talking about, secondaries or, pre-IPO companies, and that's exciting stuff, but it's so fun talking about, these other fintech and biotech and life sciences, ag tech and food tech, specifically those kind of verticals. I don't gravitate toward too much about this. But before we dive into all that fun things and underwriting, how you think about it, I want to ask you, okay, you started as a volatility trader, okay? Tell us, how you came from volatility trader to now what you're doing, my man?
Well, I actually didn't start as a volatility trader. I started as a ticket runner on a trading desk. So getting lunches and getting coffees and all that stuff. And, over the years was able to work up to a volatility trader and portfolio manager. But, that was great. And I love that. And I learned a lot as a volatility trader and, modeling and pricing assets and being able to, trade them. But, living in San Francisco, it was a natural progression to move to the startup world and really start to, transition away from something that's really, volatility trading is more East Coast or Chicago centric. So it made sense for me to move over to startups here in San Francisco because it's a huge ecosystem.
So was that, I was going to ask you, what was the adaptation? What was the bridge? I mean, because they are totally two different verticals. And so that's what kind of it was intriguing to me. So you moved, and the ecosystem where you were at, it just kind of facilitated a lot of startup kind of environment. And that's the reason and how you got active in the startup world. Is that correct then?
Yeah. So that was around like 2015, 16. And, everyone had a startup. Everyone was in the startup world and everyone was, that was the place to be, and just a lot of cool things happening in San Francisco. And, everyone was somehow dialed into some part of that ecosystem. So it was an easy transition. And, the skill set for me was, become a CFO at a startup. And, when you're working on a startup, titles really don't mean that much. You're a co-founder. It's just like who can do what and who can get it done. And, learning, it was a steep learning curve for me, like moving from volatility trading to working as a co-founder. But, I think every startup founder it's a steep learning curve, and you don't know what you don't know. So,
So let's dive into the startup world first, because I want to dive into the finances. You CFO, you worked in that area for quite a different slew of startups, and I want to talk a little bit about that and how you structure that, because that's drastically different in regards to the books of a startup versus the books of a mature company, right? Just totally different in the way you structure it. So I want to talk about that here shortly, but I want to dive into, in this area, when you were either, working with a CFO, as a CFO for these startups, consulting for them or helping them in that assistance, or just helping really facilitate, maybe capital, right? Raising. How did you, because there's just tons of startups, there's tons of different, people looking for funding. How did you navigate those waters, right? Where you were like, okay, hey, I'm going to bet on this person, right? It's betting on the jockey more so than the actual product, because that's going to obviously evolve. So how did you navigate those waters during some crazy, crazy years, man?
Yeah, the idea behind the startup is always, and everyone has tons of ideas, right? So, you take a shower, you come up with a great idea for something, you might forget about it, or you might decide to work on it. But in most cases, it's really the people behind it. And for founders, you can get a pretty good sense for if they're going to be able to make it, I guess, like what are they willing to do to get to the next level? Are they too timid, or are they too reserved, or are they overly ambitious? And so you get a good sense for the capabilities of people, and like, are they willing to, go and get a second job to make payroll next month, or are they willing to, or are they overextended, where they've kind of gone all in on something, and they'll they're just going to self implode. So you get a sense for that, and there is a balance, and there is a lot of luck involved for people, and then also people that founders that have done it before, so they have a little bit more experience, and sometimes that's a great thing, and sometimes that can be somewhat of a hindrance, but for the most part, experience and really the character of the founders.
So let's dive into this, because I've heard this numerous times when I'm talking to a lot of VCs. They underwrite the founder and the team and so forth. And I want to kind of dive in the way you think about this, because just like you mentioned, you're looking for certain characteristics, right, about this person. Hey, are they willing to go all in? I know one individual, hey, how much money of your own money did you deploy into this business? And, did you deploy, $250,000, $500,000, whatever? Then that shows, okay, you got skin in the game. So naturally that's a good sign. And then like you mentioned as well, hey, do you have previous experience in, running a company or an exit or whatever it is? However, though, there is a caveat, because obviously some of the wells, Jeff Bezos, he never ran a company before, and he obviously scaled his, Amazon and so forth. Mark Zuckerberg is another good example, right? So it's one of those things where it is a caveat a little bit, where you have to, do they hit all the check boxes? Are they a first-time founder? Sure, but they also have all these other characteristic traits. And let's dive into those other characteristic traits, in regards to, is it intuition for you, Austin, or have you just been able to talk with so many different founders that you've already got that feel, like you already have that, like that knack for, okay, I know this guy, he's got it, and he's got the winning mentality, or that woman, has got a winning mentality?
Yeah, I mean, some of it's intuition, I guess. You get a feel for a person pretty quickly. For me, a lot of letters behind your name don't, especially for a founder, it doesn't mean a lot, because the skills that you need to survive are not really taught in school. It's like a lot of street smarts. And so I've dealt with people, founders that they're really worried about their image, when they should be worried about, what needs to be done, what needs to be taken care of, and willing to go that extra step to get things done. A lot of people tell you they want to do whatever needs to be done, but when, rubber hits the road, they don't, until you've been in some tough spots, it's difficult to know what you're gonna do. So I don't know if you heard the old Tyson quote, everyone's got a plan until they get hit in the face, right? Um, so I think that's really true, especially, you look at the markets in the past year, right? Private markets last year shut down. And right now, a lot of startups are struggling because the money that was there before just isn't there. And so it's scary for people, right? And we don't know when it's going to come back. And it feels pretty good right now. We're in the middle of the summer and we have a nice little public market rally going that, you know, a lot of people hate just because it, it while we are rallying, it doesn't feel great. But so, at the end of the year, we might have a lot of, money might be coming back in the market, but, we don't know. So it's, it's a gut check time for founders.
It is a different environment, and this kind of evolves right into a great question in this next kind of segment in regards to the CFO world, because I do understand that a lot of founders during these last 10 years where there was just an up to the right trajectory and you could raise capital in a relatively easy environment, and they were relying on that next fundraise or that bridge, capital raise, whatever it was, right?
Mm-hmm.
And what I noticed though is now that the capital has dried up a little bit, I think it'll obviously deploy at some point, but we don't know the timeline on that. So it's just you gotta navigate the waters now. So my question is, as a CFO, excuse me, working with these startups, like I mentioned, it is a different ecosystem. The way you do projections, the way you obviously modify the financials of it, and even the underwriting of future kind of Series A, Series B kind of fundraising. How did you? What were certain things that you had to kind of just run with the punches a little bit in regards to kind of the margin? I would imagine a lot of that was all over the place sometimes as you're kind of figuring out product market fit, acquisition, a lot of things, and spending money, and then also raising capital. What were certain things that you had to just kind of roll with? What did that look like? Unpack that for us in regards to KPIs and the way you just kind of ran with the punches, definitely in the startup world.
Yeah, well, obviously you have your plan, right? The way things are supposed to go and the way you want them to go. And it all makes sense when you put it down on paper, but reality, things don't happen like that. And people are late on payments. Things get stolen. Inventory gets stolen. And, what are you going to do? You have to pay people. Now your $200,000 worth of inventory is gone. How do you bridge that gap? And so you have, there's the checks in the mail kind of thing. And, at that, in the startup, it used to be you'd raise money for 6 months, right? And then you'd raise money, get your money, work your plan for 6 months, but start on your next fundraise immediately, sort of getting ready for the next, you have your MVP, then you proof of concept, and, you're working through all these stages. Now that timeline, you have to extend that to 12 months because that's just kind of how long it's going to take at least, right? And maybe even 18 months. So really working that budget on a shoestring and, being smart about where you spend your money, when you have to spend it, who gets paid first, prioritizing payments. And like, for instance, there was a, SVB, nothing really happened from it. I mean, it wasn't as bad as everyone thought it would be. Like everyone thought over that weekend, people were really worried about their, am I going to be able to make payroll next week? I got to switch all my payments from this bank to another bank. And there was a real effort for guys in my seat to prepare their companies for that following Monday when they might not be able to get their money out. But that fire drill is just a really a typical startup practice where you're prioritizing things, making sure that the people you need to work for you are serviced or paid, and then figuring out who can kind of mellow over, let the accounts payable kind of float.
So let me ask you this, because when I was scaling my business, it was bootstrapped, right? Where, okay, I can only spend, and I didn't have any outside investors. The only thing I had was I had X amount of dollars in, and I could only spend X amount of dollars. And of course, we obviously put those in, buckets and all that fun, accounting stuff and whatever. But my point is in the startup world, you're kind of relying on external capital sometimes, and then also internal. Like you mentioned, there's unexpected cost, right? And my question is, CFO, how did you integrate those unexpected costs into the plan? Did you just increase the error or the margin and say, hey, you know what? And instead of anticipating, a 30% margin, we're going to go ahead and decrease it down to 20%. And there's probably going to be 10% somewhere that there's going to be, like you mentioned, inventory problems, or someone stealing, or
Sure.
something's happening, or, hey, this, that revenue, we lost that big client, XYZ, right? Fill in the blank,
Sure.
right?
Sure.
Is that what you did to
Yeah.
anticipate that? Oh, okay. Talk a
Yeah.
little bit about that, how you navigated that.
So that goes back to like portfolio management and risk management, right? So look at your real chunky expenses or your real chunky revenue. Like one time I was working as a fractional CFO for a company, and we sold a bunch of it was PPE, so all the gloves and masks and stuff to a state agency, right? And so we had a PO from that state agency, was supposed to float us for a couple months, and really we really needed it badly. It turns out that it was due in 30 days, and they didn't pay us for like 120 days or something. So yeah, and so looking at things like that in your pro forma and how it affects your cash balance. That's pretty much how what does it say? What does it do to your bank account at the end of the day? Are you going to be negative? And if you are, then you better be very, very thoughtful of that input, or making that commitment, or really planning around it, because it might be 80% money in the bank, but 20% of the time you're not going to have it, and then you're really going to be scrambling and need to go back to the well, like investors, or sell something, or eat beans and rice for the next month, or whatever it is, right? So yeah.
Well, I know in today's world, right, we've seen a lot of people extend their runway, right? And they're anticipating even, late 2025, 2025, excuse me, or mid 2025. And which makes sense. I definitely understand that. And we're also seeing some of these startups and founders and other companies as well doing layoffs, right? Mass layoffs, or,
Sure.
taking 5 or 10%. I just, heard from a friend of mine, they're doing about 10% layoff from everybody, just kind of, all across the organization. How did what were those conversations like between the CFO yourself and the founder, and the C-suite, the leadership, right? The leadership team, and having those tough conversations, having those difficult situations, say, hey, we've got money, yes, but we're spending way too much, and there's uncertainty, and yet we can grow at all costs, but also we want to grow with some good margin and profitability. What did that look like? How did you navigate that even? And is there also misalignment between building a structured business and misalignment with investors and getting, or maybe even VC partners, and regarding like grow at all costs kind of concept and kind of cadence that majority of startups kind of face, and a lot of founders have to face?
Yeah, I think those conversations have always been pretty easy for me, just because they have been, it's reality, and it's looking at numbers. And like I said, it's not like in the startup world, it's not this real division of like everyone. You're like when you say CFO, but I'm doing a lot of other things also. Like I might be helping. I don't know what it is. Like even putting things together, right? So there isn't, or helping out in a trade show booth or whatever it is. It's not like early stage where there is a real division of where title makes a big difference, right? I might be the one that signs the checks or whatever, or wires the money, but it doesn't mean that there is that real title difference. So in those conversations with the CEO, they know where the money is. They know what needs. They're apprised of the situation before it gets to there, and usually it's like how do we figure this out, and then if we can't figure it out, we're going to have to do something drastic, like stop something or cut something or cut someone or ask someone to work. Would you take equity or whatever the solution might be? Look at alternative, funding, whatever it might be. So generally, I like. It's never been like, oh boy, we have to stop. Like we know where we are, we know what's going on, and it's going to be difficult. And hopefully, we're not going into 2025 through this slowdown. So.
Did you, obviously there's a book out there, Profits First. It was been able to, revolutionize a lot of small businesses in regards to just buckets and how they're deploying capital and making sure that they have just the basics, right? I mean, we all have basics in finances in our own home, and then obviously, deploying it in our own business as well, structured kind of approach. Did you implement these kind of basic kind of stuff, Profits First kind of focus right off day one when you're working with them, or was it kind of an evolution? Because let's be honest, a lot of investors, they don't want, just money sitting there in the bank for,
Sure.
salary. They want to, hey, are we going to put it toward marketing and acquire more clients and, all this stuff, right?
Yeah.
So there's this like
Yeah.
misalignment. So how,
Well,
what, in regards to structuring on the back end, what did that look like?
So it's not, so it's the product, right? Whatever you're selling. So a, SaaS company is going to be different than a CPG or something, right? And then it depends on who's your investor base and who you're selling it to, right? So a venture fund might have like a 5 or 7 year time horizon on their fund. A family office could have a 100-year time horizon or a 20-year time horizon, or some high net worth individual could is going to have a different set of investment parameters, or even like a foundation that's just interested in pushing an idea or finding a cure for some sort of disease. So they all have different goals. So I think working towards your audience and knowing your audience, and like, I don't know how many times I've heard people say they want an IPO, right? And IPO market's dead. And like, it's sounded good in 2000, 99, 2000, whenever, I was in the middle of that, and everyone was IPOing, and it was a great idea. Now that's not what people necessarily want to hear. They want to hear, you're going to be acquired, or, more realistic expectations for when they get their money back. So, back to your question, like, depends what the product is. Does it have the scalability where it can take off? That money is, throwing money at it and scaling it all costs makes sense? Or is it something that, you have to do, with profits in mind first? So, it's not a direct answer for every company, I don't think so.
It's very contextual, which I figured it would be. It's just what that looks like, and as well as the investors and so forth, and the founder as well. I want to talk a little bit about startup advising. I know you not just the CFO work, but you also advise holistically, and then also work very closely with a lot of high net worth, ultra high net worth individuals, and helping them find the deal flow, right? In regards to what I just mentioned: fintech, biotech, life sciences, ag tech, food tech, and all that fun stuff, which we're going to be diving into very shortly. But I was curious in startup advising, with the companies you've worked with very closely, what have you noticed is like their weak spot in most startups, or maybe founders? Because some founders come in very technically advanced, where they know the back end stuff, they know the product, they're all about this. Some are more marketing, sales, all that fun things, right? They're charismatic and all whatever. Like the characteristics, personality, totally drastically different, but they can win and they can accomplish things. And you're advising them on a lot of different things within their whole organization, whole business, talent acquisition, all that fun stuff. So out of all the individuals, if you could, I know it's probably contextual depending upon obviously the company, what they're looking for, but like holistically, are you noticing a trend in regards to what most of them is their kind of their weak spot?
Yeah, as a trend, so for a founder that hasn't started a company or run a company, and we get a lot of like for instance, in life sciences and biotech, a lot of really, really smart research based founders, right? So some guy that spent so many years researching something, they think they found something, but they don't know how to go to market. They don't know what's the right numbers to be asking. You can really tell what they don't know pretty quickly. Like for instance, just how you form your company, and how much money you need, what's the return profile going to look like, and like when is an investor going to get it back, kind of thing. And those are some of the basic questions that any investor wants to know, and they're just best ways to like form your company, make it easy for investors to understand. Sorry, I think we cut out there for a second. So, depending on the background of the investor, like that is just some of the basic blocking and tackling that investors are going to know about, and then that makes investing in a company easy. Like I've seen a lot of founders. They have great ideas, they have a great opportunity, and then they set up their entity wrong, right? And it's hard for an investor to wrap their head around and value. So it's just a quick pass automatically, just because the vehicle was set up improperly, and maybe they had an idea, they got some bad advice, and it just makes it sort of a no-go from the beginning, unfortunately. Yeah.
Austin, I think that's so interesting that you're mentioning that, because I was literally just talking to someone, I think 2 weeks or 3 weeks ago, and his concept, he sent me his deal flow. And it is so interesting how a lot of investors and LPs, family offices, they've got a high bar, right? They're very institutional. Maybe they're very just really focused on, hey, if they don't have, XYZ set up in their company or whatever it may be, it's a hard no and very quick no. And sometimes you only have one time to pitch these individuals. And in a macro economy where it's already hard to raise capital, it's like you got to really dial these things in. And then also on the side point in regards to, some of these founders are so technical or research focused, where they actually have a cool product and it's really awesome, but they need to lean on someone that maybe knows how to actually get it up and running in deployment. And we've all have talked to about obviously Warren Buffett has Charlie Munger, and Bill Gates has Paul Allen, all these individuals, all these individuals had their kind of partner that kind of compensate, that yin and yang approach. So when you identify with a startup, when you're advising them, and you're automatically, because you've done this so much, and you kind of just know the trends, and you're able to identify the problem very quickly, what does that look like in regards to fixing it? Are they pretty lenient on that, or are they pretty like, okay, hey, we need, what does that look like? Yeah, I see you're shaking your head.
Yeah,
Go,
yeah, yeah.
Austin.
It's like, the old saying, you can lead a horse to water.
Yeah.
Yeah. So a lot of times, if they want to drink, they'll drink, and they'll figure it out. And, I don't have all the answers, but I have a good network that will help you get the answers. And, we do a lot in biotech and life sciences, but I've never walked anyone through a FDA approval, right? I've worked with a lot of companies that are getting through it and they need money for it, but I don't know the steps. So, but I know people that do, right? And if you want to, I can help you out. And, it's always going to be a balance between or among a bunch of things, right? Like what does the founder know? What do they think they know? Are they willing to accept help? A lot of people can't accept help. They want to do it. I learned that the hard way in my life, like wanting to do everything myself. And, it's always easier to ask the expert, I think. But then, there are also budgetary constraints. Like all this stuff costs money and everyone has their hand out and everybody wants to, a pitch deck they want to charge you 20 grand for, or a pro forma, and that's another whatever. And it adds up pretty quickly. And for a founder, there are a lot of people that are, they have their hands out. Everyone wants, they want to make a living off of it. Everyone has to make a living, right? And so being part of that founder thing is being shrewd and being, tight with your money in the beginning. And so you're not taken advantage of, but, getting what you can, getting the most value of what you can. And then being able to, classic founder move is a pivot, right? Like you didn't do everything right in the beginning. Can you pivot real quickly and learn from your mistakes or gain from your mistakes actually? And maybe they're not mistakes then. Maybe they're just part of the evolution. But yeah, so, and that goes back to your earlier question about sizing guys up when they come in and ask to work together. Like where are they mentally in this? So yeah, so.
And what I find so interesting about you is because you've been in this ecosystem, this environment for many years, and you've had these conversations and dialogue, you have enough internal data to pull from, to say, an experience as well, to say, okay, hey, very quickly you're able to isolate and kind of pull, the winners and the losers. Now, of course, you'll probably get that wrong, but that error has gone down, that margin has gone down tremendously, which is really interesting. Now, I want to talk a little bit about you guys, because of this atmosphere. Let's be straightforward, right? You are in where everybody's at, right? And all the deep tech, the fun, exciting projects, all that craziness, right? What led you into the fintech, biotech, life sciences, ag tech, and food tech, specific verticals within the whole tech vertical?
Yeah. So a lot of it has to do with where I'm positioned, right? Like I live about an hour north of San Francisco now. I grew up in the city and spent a lot of time in the Bay Area. So those verticals are hot in the Bay Area. And most of my interest in the startup ecosystem is just because I like to see what people are doing, and my curiosity. Food tech is big in Berkeley, so we see people doing crazy stuff like like the leather out of mushrooms or whatever. Like some of the stuff you can't believe and it is not believable, and then they do it, and you're wondering how they did it, and cultivating food, and it's just really cool stuff. And and you bump into people at, at the bar or at a restaurant, or you just meet people that are working in it, and then conversation starts. So it's cool. And fintech, my business partner uh, had an early exit at crypto-based fintech years ago. So that's always been, and it speaks to my portfolio management background, and so that's easy for me to understand and see where the value is there. Ag tech I love, and it has been like sort of a pet project of mine, just because ag is huge, and living in San Francisco, like, we're an hour and a half from pretty much the United States breadbasket, or where all our vegetables are, and almonds and everything grows. And but to tell you the truth, when I lived in San Francisco, I couldn't tell you how to get there, right? It was just over a bridge and then down the freeway, over a hill, and then there it is. But when you're a city kid, like, that doesn't, so I ag tech I love, just because it doesn't really get the respect that it should. And so then that means there's value there. And
Which makes sense because there's a defensible moat, and obviously the higher the bar of the entrance, or lack of the information there is, the better the opportunity. When you're
well,
looking at ag
well,
tech,
with tech and ag tech, there's just so much low lying edge, right? Like, places where technology, and you see this in like construction tech and property tech, like, just where there are still a lot of relationships and a lot of uh, just a lot of places where efficiencies can be found. And they're the uptake in technology, while they have really, really sophisticated tractors that run themselves, and they're on a grid and they do everything, or they have other management systems that are, but there's just, like, in the like genetics, or management of farms, or just a lot of cool possibilities. And like, pollination, right? There's a company out there that does smart pollination, and just creates easy, not, I wouldn't say easy, but just like obvious places where efficiencies can be found that haven't been found because technology hasn't been applied.
yeah, that's what I think is so fun, is when there is this adaptation or this integration between both of those verticals, tech
Mm-hmm.
and ag, is a really great example. And it hasn't been revolutionized for a long time. I mean, when we look at the instruments and the machines that we're still using, it's just like, oh wow, we're still using this. And I mean, it's crazy, but it's really exciting as well. Now, I'm not involved much into this. When I don't deploy a lot of capital toward these sectors. That's why it was kind of fun to have you on as well, talking about this. When you're looking at this, or investors, right? Because you work closely with startups and founders, as well as a lot of LPs, right? When investors are asking these questions and looking at these kind of underwriting these deals, what are they looking for? I would imagine, because of this sector is slightly different, I would imagine the timeline in regards to exit is a little longer. They anticipate a little longer, right? And then also, maybe sometimes you have to work a little bit with these kind of sectors, specifically biotech. I'm thinking of, you have to work with government agencies a little bit to make sure that there's a proper kind of next phase, next whatever that looks
Mm-hmm.
like in regards to the company. So when you're having these conversations and then pitching these investors to make sure that there's a good synergistic relationship between founder and LP, what are you noticing? What does that look like in regards to how they're underwriting these deals specifically? What questions? What are they looking for, et cetera?
Yeah. Well, biotech's, and with the FDA, that's a binary event usually, or there's always an event date there, right? So that one is, it's difficult because for for instance, we have one right now that the FDA date has come and passed, and they're still reviewing it. So it's very it's kind of nerve wracking, right? So we're waiting for data, waiting for everything. All the questions from the FDA have come back and they've been answered, and the questions have been good. So we'd expect a good outcome, but you don't know until it happens, and then getting an investor to focus on it is difficult. And you can set up the risk reward and the expectation of your investment, and it makes a lot of sense. But a lot of time getting these guys, getting their attention and getting them to focus on a deal is difficult because there's so much competition for their attention and for showing them deals, that there's a lot of brain drain that occurs. And if a fund, like if it's a small fund, like you have a small raise, so real big funds can't participate, so you have to go to smaller guys that are interested, but there's a lot of work into it, right? Like understanding the science and understanding your, like I said, your expectation and handicapping that. So that on that side, that is on the biotech side, that's a little bit nuanced because of those milestones that you have to reach and the data. On the ag tech side, they really aren't that much different than just a regular VC type raise. There is it is a little slower because you have seasons, right? So, you have to. Mother Nature doesn't speed up for anyone. So, but they're two halves of the world also. So it doubles your growing time. But they still have the same expectations. Like depending on what their fund is, if it's 5 or 7 year time horizon and the assets in it and kind of their expectation for their IRR. Those are the kind of questions they ask, like, what do I get and when do I get it back? And, what's your plan here? What are your milestones?
I would imagine a lot of individuals that invest into these sectors either came from it or very, very educationally based in these sectors. They know what's going on. They kind of know the top front of things. Because someone literally sent me, 3 or 4 days ago, a slide deck about lithium batteries and forklifts, and of course I reviewed it, but I have no idea. They just technical jargon, and I'm like, I have no idea what's going on. I had to get on a conversation with them, and it's like, what's the application of this? I'm not going to read this 7-page slide deck. So
Right.
when you're looking at, and that's one of the reasons why I want to bring you on here to bring awareness to these sectors and the importance of it. Do you find majority of the capital deployed in these sectors are VCs, or are they a lot of individual LPs that have come from this sector that are very familiar with it? Same thing with AI, right? We see a lot of people deploying, a lot of family offices deploying, or kind of collaborating with a lot of VCs that maybe have a fund that focuses on this region to be able to at least get exposure to it. They may not know it, but they kind of rely on experts and expertise in regards to fund managers when they're deploying capital. What does that look like when you're having that relationship between both?
Sure. Yeah. We see that all the time. Like, in these deals, if having a lead is a huge benefit, especially a strong lead that has a good name in a sector or a space, or because they're going to do 95% of the legwork for you. Like they get in, they're going to look around in the your VDR, your data room, and make sure that things are there. Make sure, and obviously the leads can make mistakes also, like we see with so much of crypto land right now, like where people did their due diligence, supposedly, even not in crypto, like just some of the scams that have shown up. But that's It's going to happen, unfortunately. But having a strong lead and someone that's known in the space, and they have good analysts, and they have the resources to throw at it. If you get that, you'll get a lot of follow-on money from guys that are just managers that have respect for other analysts and VC money. So like you may have a $25 million raise, a $10 million lead, and then other guys will throw in $1 million behind it and fill you out. It is helpful.
That makes sense.
Yeah.
I wanted to slightly pivot a little bit. I know you're obviously in the San Fran and you get a ton of deal flow and you're very well connected in that area. And of course, throughout the United States as well. But I had someone on my podcast just a few days ago, actually. And, we're talking about emerging markets, UAE, and we got Asia. And I did want to just kind of pivot slightly and talk about this. I know, like I mentioned, you're right there, active, but I would imagine some of the dialogue, some of the, communication has kind of talked a little bit about this. You're starting to see some of these other nations and other kind of wealthy nations really, keeping a lot of their deal flow in-house, right? In their nation. They want to obviously build it, maybe take some of the West companies and have a presence in those areas. What does that look like? How are you guys navigating that? Maybe even saying, hey, how can we collaborate with these other family offices and high net worth individuals in these other areas? Or how can we get exposure to, these emerging markets that we are seeing kind of, trending up to the right?
Yeah, I honestly, I don't do much in there. We do cross paths a little bit, but it's always hard to. It's just another. It's something that's really not. I couldn't speak to it as my strength. We do see a lot of flow from Israel, and that's only because one of our our broker dealer partners is there, and there's a lot of ag tech coming out of Israel. So that's a big. I like looking there for flow, and it's typically pretty decent, and so it's something that I look at. UAE, I really don't. It's kind of a mystery to me. Honest, not a mystery, but just not a focus for me or our company. But there are a lot of interesting things there. I do. It's a bandwidth thing, honestly. So. Yeah.
Well, specifically
I can't give you a better answer than that.
No, that's perfect, because even specifically with Israel, what I found so interesting is, let's be honest, I think U.S., we have just a lot more LPs in regards to, wealthier individuals that can deploy this kind of, in this area. I'm not saying obviously, but I just had someone, a VC that was talking, came from Italy, and they said they just don't have the pool of money like the U.S. does. And so they kind of have collaborations or connections or whatever. My question is, and so kind of talking about Israel, since obviously you have some deal flow from there, what's that relationship look like? How do you guys collaborate? Is it, hey, they've got a founding, they got a position there, they're exploding in that area, in that region maybe, and they want to have a presence in the U.S. internationally to be able to obviously capitalize on that.
Mm-hmm.
And if so, how do you then navigate the conversation between these LPs? And we're just talking about Israel because obviously, like you mentioned, you have a presence and you're very familiar with that area. And it's actually the tech hub over there. It's very interesting to see that.
Yeah, they've made a real effort. I'm assuming it's the government there has made a real effort towards. So think about it, like Israel is like a postage stamp, right? But they have to make do with what they have, and so they have a real strong, like the number of Israeli ag tech companies is crazy, right? And they desalination, the pollination company that I mentioned, the list can go on, and so they're doing a lot with a little, which is what you need to do if you're trying to feed the whole world, right? And so, yeah, the technology starts there, but there's no real market there for it. I mean, there is a market, but no real market. So yeah, they're trying to expand in the United States, and they're set up as Delaware C corps, right? And they want to raise money in the U.S. to expand and scale in the U.S. generally, and then around the world. So everyone needs pollination. So it's like they needed it. They validated it there, and then now they move over here and move to the rest of the world, kind of thing. So
I have not deployed any capital into a company that has an exposure or started in another country. Most of them are here in the U.S. or real estate, et cetera. My question then is, do they make U.S. laws and regulations? And because we got a relatively good relationship with Israel, do they make it easy for to get a presence here? Right? They have the technology there to bring it over here and then be able to hire. I would imagine so, but I obviously, again, ignorance is bliss. I'm not sure. So, and if it is difficult, even deploying capital and so forth, what does that look like? How do you guys, really help them expand and get a really deep presence here, even with competition, et cetera?
So let me think. That's a bunch of things in there. So I have seen issues with U.S. companies selling technology abroad, right? And especially companies that are, selling to defense, right? So technology's there. So that's one thing. Selling here, no, I haven't really. I mean, I haven't seen any real any issues there, and like I said, they're Delaware C corp, so they're domiciled here essentially, but the technology, the founders are from abroad. So I couldn't. I'm sure there are some issues, that are you can overcome and work around or try to figure out. So, but we see that a lot with companies from Latin America setting up their C corps in Delaware, and they have business down there.
Austin, so this Austin, this makes sense in regards to kind of what you're saying, and I really appreciate unpacking this. I'm curious because we're talking specifically about ag tech. And obviously somewhere in that world, in that environment, it touches, food of some sort, right? And it's, obviously affects what we've got going on as well and here in the US. Because of that, I would imagine there are certain compliance issues that the company, when they get, I would imagine the structure of building an LLC is very simple, very easy, hiring, deploying capital. I mean, we make it pretty simple, but I would imagine the product itself, to make sure that it integrates into the US for acquisition of new clients, et cetera, right? I would imagine you would have to get compliant with that, depending upon obviously what the product is, right? But same thing with biotech, right? You can't just bring something over here. It has to go through all the compliance, not only obviously in Israel, but obviously here and any other location or any other nation that you want to deploy that product. What does that look like? Is that because it's ag tech?
That's a lot of research.
Is that a different thing? Okay.
Yeah, I mean, that's a lot of research, and you're going to have federal, state, local compliance, like labor laws, all that kind of stuff. Like depending on what you're doing, what market, there's regulatory compliance everywhere. So yeah, it's not easy. And you just have to think about it and find the right advisors and know who to ask, right? And a lot of times, sometimes you get, if you don't ask the right question, if you don't ask and you don't get, it can if you don't get good answers, it can really hurt you in the end. And see some bad info out there, and that's like the FDA thing. You need to go the right route, and I mean, look at crypto, right? No one knows what a security is, or no one. I mean, we kind of know, but there's no real definition or no real judgment out there. Everyone's scared to say something, and so people are doing things without clarity, which is a risk, right? So it might work out for you, and it might not. So it's a big bet. Other sectors like labor laws, and especially in ag, right? There are a lot of, California is different than Oklahoma. So.
Yeah, that makes sense. And I was just curious on that at a micro level because I would imagine there is some sort of compliance or some difficulty, but it seems like again, it's very contextual. I understand that with a product, what that looks like, how it's going to affect, et cetera, et cetera. Right? There's so many questions that go into it, and you have to just unpack and have to have the right team to make sure that you navigate it accordingly. So I appreciate you talking about this, Austin. This has been a magical and a very, very informative conversation. I just appreciate you going micro, just talking about the CFO side of things and business, how to navigate that as a startup and the evolution of a company going from startup to, a mature company and what that looks like. And then also talking about, just kind of the way you think and underwrite a lot of these companies and the way you look at these and diving into these specific verticals in the tech world and the excitement and the ag tech and bringing awareness to these things and how to underwrite them and how to look at them and what an investor's looking for, what a founder's looking for, and all of this amazing conversation, and then also emerging markets, right? Specifically Israel, we kind of really dove down deep into. So this has been a really awesome conversation, Austin. For those that are listening, that are looking to just connect with you, learn a little bit more about what you got going on, or maybe even reach out and say, hey, I may need CFO or startup kind of consulting a little bit and navigating these crazy waters that we know we're in. How do they reach out to you, my man?
Yeah, I mean, we have a website, Aureate Capital, or aureatesf.com. That's a great way, info at. And then, I don't know, is there some way I can put well, no, I think the best way is through the website. And there's a way to connect there.
Awesome. Perfect. And guys, to make it very simple, I put all those links in the description below, his LinkedIn, his website as well, so you can reach out, connect with him. And highly would recommend it. The biggest thing in this world is it's about finding the people that have the Rolodex, right? Finding the who that knows how to get things done. And that's really what it comes down to. And he's got a huge Rolodex, been in San Fran for a long time. So he knows the who's who. And so totally would recommend reaching out to Austin. Austin, again, I really appreciate you being on here. Guys, that is my friend, the co-founder of Aureate. Guys, that is Austin Aureate. Yep, there we go. So that is the co-founder and managing partner of Aureate, my friend, Austin Milliken. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.
Thank you, Christian.